Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell. I'm a senior market specialist at FXCM, and my email address arthur@fxcm.com. Today is Tuesday, the 3rd of May, 2020. We're just going to bring up our high-risk investment warning. I'm going to keep this on screen for a few moments. Hey, Katie. Morning, Anna. Nice to have you guys on the webinar. Thank you, everyone, for joining this morning. Just going to bring up our market commentaries disclaimer. All right, and market scope, CNBC and trading view, and we'll bring up CNBC first. Just waiting for, here it comes. All right, the headline reads as follows: European markets set for mostly higher open after a big reversal in US markets. European markets are set to open mostly higher on Tuesday, clawing back Monday's losses as investors monitor key monetary policy decisions around the world. It comes after US markets staged a major reversal to start the month on Monday, with the Nasdaq composite rising 1.63% late in the day, after falling 1.07% earlier, and the S&P 500 increasing 0.5 percentage point. European markets closed sharply lower a day earlier as investors digested weak economic data out of China and Germany and a sudden flash crash in Sweden's OMX 30 index. Focus will turn this week to monetary policy decisions from major central banks, with the US Federal Reserve expected to announce 0.5 percentage point increase, and that's going to be on Wednesday. Market fears have been mounting as to how aggressive policymakers will have to be in order to rein in inflation. Australia on Tuesday hiked its interest rate for the first time in more than a decade as consumer prices surged. Stocks across Asia Pacific were mixed on Tuesday, with Hong Kong's Hang Seng Index climbing on its return to trade from a public holiday. US stock futures were fractionally higher in early market, pre-market trade on Tuesday after Monday's volatile session. Wall Street is coming off a brutal April, the worst since March 2020 for the S&P 500 and Dow. Global investors continue to monitor the war in Ukraine and its geopolitical implications, with EU leaders set to work on a Russian oil embargo this week. The United Nations and International Committee of the Red Cross on Monday began evacuating civilians from the besieged southern port city of Mariupol. All right, just wanted to bring this chart up here. So just to give an idea of what we look at. And we're looking at the US 10-year, just your normal US 10-year, and then what I'm doing is I'm subtracting the break-even rate off of that. This is effectively what your TIPS is. This is what your Treasury inflation protected securities are, and we've got this situation now where real rates have turned positive. So this red line here, that's the zero line. Okay, that's the zero line. So we're now above zero. Real rates are firmly positive, according to break even. There is an argument to be made whether the break even rate is reflecting inflation fully. Because we know we're around about 8%, right, which is not reflected in the break-even rates. But if you just take the real yield minus the break-even, we've gone positive. So what's the big deal about this? Well, the big deal about real rates is that it's an incentive. Okay, it's an incentive to move your money into safer securities. In other words, what's happening here is the return is beating the inflation adjustment. The real rate's beating the inflation adjustment. Okay, that's effectively what it's what's happening here, and that might mean money rotates to the safe havens because all of a sudden you're getting a real return. Is it true that inflation is a lagging indicator and that it takes a year to see effects of policy changes? Yes, that is true. It is, inflation lags, quite correct. So the CPI tends to lag. So what happens is that once we hit the apex of a business cycle and we turn and we go down, you'll still see inflation rising because there is a lag in terms of inflation series. So that is true, Anna. That is true. Employment's also lagging. So the employment rate is lagging. What's interesting, well, the unemployment rate's lagging. What's interesting is to take a look and see if overtime is being cut back. You know, so generally, what happens at the bottom of a cycle after a vicious sell down, employers are not sure whether they have sort of reached the bottom and they are justified in hiring. So what they'll do to keep up with demand is they'll increase the hours worked. So if those start ticking up, that kind of would be your coincident. Similarly, at the top of a cycle, employers are reluctant to let employees go, so they'll start cutting back on hours before they start laying off. That's generally what tends to happen. So there is a lag, yeah. So employment inflation tends to lag. There are leading indicators. Stock market actually is a leading indicator. The S&P 500 leading indicator. Non-farm payrolls is a coincident indicator, and there's a whole lot. I'll need to double check exactly which ones are leading, coincident, and lagging. But I know that the CPI does lag. All right. So here's the real rate turning positive, and so the question is now, does it pull capital away from risk markets and push it into the bond market? The bond market's been absolutely slammed. So you can, if you are a fixed income investor, okay, you're probably buying bonds at a really good price at the moment, and that's why the yield to maturity has pushed higher. So that's something that is worth keeping an eye on. The fixed income market, do they see this as a time to be buying value, or are they still waiting for lower prices ahead? All right, so that's this US 10-year and the minus the 10-year. Another thing just to consider here, given that, you know, we're about 36 hours away from the rate announcement. So we have looked at this previously, but what I want to do is I want to bring up the US 2-year, which is a good proxy for monetary policy. So let's just bring that up. Let's get rid of these guys. So this is the 2-year. I really want to get all of this. All right. So what are we looking at here? Well, we want to put the Fed funds rate on top of this as well. So I'm just going to click plus. All right, and let's just make this black so it's easier to see. All right, so what we're looking at here, I think, is a very interesting chart. The idea is we're looking at two different series. The candlesticks of the US 2-year, which you can see is a very good indicator of where Fed's funds rate should be. It's always going to be, it's not going to be one for one, right? There tends to be a lead or a lag. Where this gets exceptionally interesting, is this where we are right now. Okay, here's the Fed's funds rate. Here's the 2-year. Look at that gap. Look at this gap. Okay, I really don't like this orange. Let's just change this out. Let's get this a different color. All right, so now there's two possibilities here. And what are these possibilities? So the first possibility is that the Fed is way behind the market. It's what we call the Fed's being behind the curve. And that's been the indictment, the criticism against the Fed, is that they've consistently been behind the curve for the last year and a bit, whereas they should have been raising perhaps a year ago. They weren't, and now they are again too far behind. So if that's the case, well, the Fed has got to get to sort of 2776. Okay, but it's way behind. So everybody is suggesting a 50 basis points tomorrow. That seems to be priced in. There is huge. I don't think the market is acknowledging the potential for 75 here. It's, in my opinion, there is a much higher probability than the market is pricing in that we get 75. Now, we might not. We might get that 50. The reason we may get that 50 is because there is still obviously geopolitical issues, the supply issues. The Fed doesn't want to spook the market. Okay, so that's. However, if those factors if those variables weren't there, 50 would be too low. It would have to go 75. They're playing catch up here on a huge basis. So the scope for a surprise tomorrow is probably higher than most market commentators are acknowledging, in my opinion. We'll just have to be very cautious tomorrow. If anybody's trading the market over the announcement, that's a high risk announcement. It's always high risk. It's always high risk. You know, if you're trading whilst the central bank, specifically the Fed, is announcing its rate policy, there's always going to be huge volatility, right? There's going to be huge volatility. Well, tomorrow the uncertainty is heightened. Heightened uncertainty means heightened risk. It means you've got to be prepared for the volatility, for that swing, if you are trading over that period. Okay, very dangerous period to be trading. So the scope for surprise, I think, has been underestimated. We are miles behind the market, miles behind. That's the first possibility. That's the first possibility. The second possibility is, of course, that, well, maybe the market is way too in front. That's the other. So there's two possibilities. In other words, the 2-year needs to pull back towards the Fed's funds rate. That has happened. Has happened. Here's a big jump up and then it pulls back. Here's a jump up, then it pulls back. Here's a jump up, then it pulls back. So it has happened before that the market has been priced incorrectly. What would be the fundamental reason for a mispricing in terms of the debt market? I would suggest that the market recognizes perhaps that the Fed doesn't have as much leverage to be as aggressive as it wants. What would be the case where the Fed loses its leverage? Well, that would be stagflation. Okay, that would be the stagflationary environment, which of course cannot be discounted. However, okay, the communication from the Fed is that they are aggressive, okay? And if that and they've generally been pretty good with their communication. So we should get a 50 minimum. I wouldn't be surprised to see the 75, which would be a surprise. Okay, so this is just, there's a huge gap here. Okay, and if they don't go 75, then there's a good chance they go 75 in June. Okay, so let's just understand what we've talked about here. Okay, there's two very important things that we've talked about here. The first thing is, well, the second thing is, it looks like the Fed's way behind. Okay, it looks like the Fed's way behind. What's the other thing that we've discussed? Well, the other thing we've discussed is that real rates are positive. Let's just take a look at that. US 10-year minus, just put in the break even. Okay, so these are big deals. Okay, and by the way, it's not only that, there's a third thing we can actually even add to this, the speed of turning positive, the speed of the real rate becoming positive. So all of a sudden, we can, I think, build on a case where the Fed's way behind, real rates are positive, the rate of moving positive has been exceptional. If I go to the monthly, I just noticed this when we turn to this. Let's take a look at the monthly. Okay, look at this appreciation. Okay, towards heading real. That's a huge candle relative. Here's a couple back here. Okay. You guys hear me? Well, just let me know. You guys can hear me? Okay, sorry about that. Okay, cool. So, we've got the Nasdaq on screen. Can I just confirm? Can everyone see the Nasdaq? Can everyone see? It's a little distorted. All right, let me just take quality slow. Yeah. Okay. Just double check. I'm going to continue. This is the Nasdaq over here, and what I want to point out with regards to the Nasdaq is the trend. Let's just take a look at the trend here. Okay, let's just take a look at the trend and what we use to define trends in technical analysis, right? So we're looking at a weekly chart. So this is pretty much a primary trend we're looking at. So we'll just put in a reference peak here, and then we'll just keep in the spirit of the peaks and the troughs. Take a look here. Here's a trough. Once we've got these references, here's the lower peak. Here's the lower peak, and of course here's the lower trough. Okay, so there's now a lower trough. So what's that? This is a down. Okay, this is a downtrend. So the fact that we've got this downtrend here is quite worrisome. Downtrend is effectively a bear market, it's a bear trend. It's just rates that are increasing. They've gone real. The rate of change has been huge, and you've got the Fed that is way, okay, and you can see that it's affecting the growth market. The growth market is the Nasdaq. Nasdaq is being smashed. It's getting pushed down. Let's just understand why. It's no use me saying because rates are going up, that's why the Nasdaq is going down. No, we must understand fundamentally why that is the case. And I think that everyone here is comfortable with the time value of money. We're just going to take a look at it again. Okay, so let's just take a look at this. I'm going to just take this out. This is huge. Okay, what I'm about to show you is huge. This is exactly what's happening in the market. This is exactly why the Nasdaq is under pressure. It's because of something we call the time value of money. So we're going to call this value. Let's call it present value equals, okay, cash flow, which would be dividends. Think about cash flow as dividends. Okay, we've got to get rid of this underline here because it's going to confuse the issue. All right, sorry, I'm just having a terrible time with the connection here. All right, that's better. All right, let's just continue. There we go, I'm begging your pardon. All right, what we'll do is we're just going to put a line here. Okay. And it's the second part, the denominator. 1 plus R, okay, 1 plus R Jim, having a terrible time with the connection this morning. I'm humbly apologize. All right. So the point is, we've got R here. R stands for required rate of return. Okay, R. Now, inside required rate of return, think about what we just said earlier. We said that yields have just turned positive. So your required rate of return is now to beat inflation because the real rate is greater than your inflation rate. So R is increasing. R is increasing. So if the R is increasing, it's the denominator. It means that it's putting pressure. It's putting pressure on the present value. It must be putting pressure on the present value because the present value, okay, is a numerator. It's the present value over 1. So the present value is inversely related to R. Okay. Now we've already seen R is turned real. It's moving up. Look at the rate of change here. It's huge. It's a huge rate of change. Okay. So that is a big issue. And we go back to this. So your denominator is increasing at a huge pace. It must be putting pressure on your present value. Why Nasdaq? Why is Nasdaq the one market that's getting hit so hard? And that's because of N. That's because of your time. N stands for time. You see, we're valuing expected future cash flows, which think about them in terms of dividends. That's what we're looking at. Growth companies, which is exactly what the Nasdaq represents, keep their earnings and reinvest it, and they don't pay out dividends. And that's just because the business needs that investment. Well, that means we're only going to get dividends at some stage in the future, far down in the future. And if it's far down in the future, it's exacerbating the pressure on present value. So as R is increasing, given the timeline out when we're going to receive our cash flows, present values are getting hit terribly. And what does that mean for us? It means we're in a downtrend, lower peak followed by a lower trough. And the scary thing here is we're not oversold. Okay, so the RSI, we generally use the RSI to pick up on oversold conditions. We know we're near oversold, so the scope for further decline is certainly there. And that is reflected in stochastic. Okay? Stochastic gives very different signals to RSI. RSI gives us our oversold, gives us our extreme. What does stochastic gives us? Stochastic gives us momentum. So we're getting a downside momentum here in a downtrend. That's hugely dangerous at a time when the Fed is playing catch up, at a time when real rates have just gone positive, at a time when real rates are appreciating at an exceptionally fast pace. Take a look what happened the last time we were in a sort of an upper quintile here. You can see that the Nasdaq moved really nicely, didn't it? Okay, over here it moved really nicely. So the same can be said if we spend an extended period. If we spend an extended period down, well, that's going to pull price down, and there's still lots of room for the market to move. So what does that mean? It means that if there are any rallies here, beware. You've got to beware. Okay. What we looked at on the DAX, I'm just going to the DAX now, and I'm going to go back to oil, Katie. I just want to bring up DAX first, okay? Because the DAX, what were we saying with the DAX? Okay, what were we saying with the DAX? Here's our lower peak, lower trough. Okay, you can see that it's not quite as sold off as Nasdaq. It's not quite as sold off as Nasdaq, and that's because Nasdaq's taking a real a real pasting at the moment because of the time value of money. But time value of money will affect all risk assets. It's just the nature of when. Remember, we said, we asked, is this a bear market rally? That's what we asked. Okay, and it looks like it was a valid question because it came back, hit the 62%, bounced off it. So the rally here was suspicious, wasn't it? It was suspicious because it's not the bear market that robs us of our capital, it's the bear market rallies. So now we go back to Nasdaq, because that's where we were looking. And if we take a look at Nasdaq, well, the bear market rally was there as well. Okay, the bear market rally was there as well. Any sort of rally now, okay, is going to be suspect as well. It's going to be suspicious. We've got a lower peak, lower top at a time when rates are going to really start influencing the present value of growth. Must be that way because it's a mathematical construct, right? So the idea here, Katie, is whilst we may be seeing some sort of people trying to buy the dip here, or let me, instead of saying people, let me say market participants. Well, those are playing with fire because it could be that bear market rally. It may be that there is some serious value here. If there is value here, I think then it's not the Fed funds rate that catches up to the 2-year. It's more that the 2-year drops and catches and goes down towards the Fed's fund rate. And what we can do is we can go down to Nasdaq daily. Take a look on our daily chart at where we are in the zone analysis. We're in zone 3. Zone 3 is our area of weakness. That means potential opportunity here. So let me just add a percent K here. Sorry, a percent D, I beg your pardon. Okay, so you can see we've got the crossover here, percent K crossing below percent D. You can see that the moving averages are about to cross down. Okay, so it looks like we're about to get our dual trigger. Now, if we get the dual trigger, and if we head towards the lower quintile, that means there's the pressure on Nasdaq. That wouldn't be surprising considering that we just broke 3% on the US 10-year yesterday. All right, we go through to the DAX. Okay, let's take a look at DAX. All right, DAX is not quite as bearish as Nasdaq, and that's because of that time value. But what is interesting here is that we're starting to get the squeeze. Okay, so if we're getting a squeeze, it's potentially warning us that there's going to be an expansion. An expansion in the Bollinger is an expansion in volatility. If we're hanging out in zone 3 while that expansion occurs, it's kind of looking up below. Just two more instruments. We must look at 3. I beg your pardon. We must go back to oil. I just want to take a look at US dollar and oil, and US dollar, gold, and then I'm going to go to oil. So go through to US dollar, firmly in zone 1. We are overbought here. But the problem with this overbought reading, by the way, is how far behind the curve is the Fed? Because if they're very far behind and they start pushing for 75 bips, okay, they will carry on being an overbought. Okay, so but the strong US dollar, look what that's doing to gold. Look what it's doing to gold. Okay, starting to push gold down. Okay, starting to push gold down in the daily, where we've broken into zone 3, right? We can even take a look at Bitcoin here. Bitcoin holding up, that's still in zone 3. Okay, let's just take a look at oil. So we'll just take a look at US oil today. All right, take a look at this squeeze. okay, starting to squeeze. If it expands and we stay in zone 1, okay, then it's moving up. Go through to the go through to this. Okay. This looks very much like a pennant. If it is a pennant, that's a continuation pattern. Okay. So we don't know what the pattern is until it completes. Okay. But if it's a continuation, then I would suggest we're moving in that direction. Right, we're pretty much on the top border there. Let's just take a look at UK oil. Sorry, I brought up the wrong one. UK oil. Okay, very similar. Very similar. Okay, so we're just going to see if these are in fact continuation patterns. So at the moment it's in neutral, but there's a squeeze. So we've got the DAX squeezing. We've got oil starting to squeeze. So it looks as if there is going to be some sort of volatility soon. We can't say when. Okay, timing is very. So what we'll do is we'll keep looking at movements into zone 1, into zone 2, into zone 3. And we'll keep an eye on that. But right now, the rates, I think, are the big story. Specifically, we've got 36 hours to see how it plays out, and of course, who's playing catch up here? Is it the Fed, or is the market ahead of itself? All right. Sorry about the sound issues. I don't know what happened there. You guys can hear me loud and clear now, right? Okay, cool. Let's finish up here. I'll upload this and I'll put it onto the Telegram channel. We'll see how the market reacts today. I think it's a very, very tough week because we've got the Fed right in the middle. Let's see what kind of communication we get from. All right, guys. Thank you very much, Anna, and thank you everyone for joining. Apologies for the sound issues, and I'll speak with you guys tomorrow morning.